Welcome everybody to Arnott Opportunities Strategy Update. Since we last spoke to you all, we're in the midst of the COVID pandemic, and now we still seem to be in the midst of it. So I hope everyone's as safe as they can be. Just want to introduce to you the other part of the team here. We've got Yianni and I run the portfolio together, and we've got Andrew Coleman, who has joined us as an investment specialist. And if you've got any questions, feel free to reach out to Andrew after the presentation. Today, what we want to cover with you as material investors in the strategy ourselves, just want to do a review of our thoughts and reflection on the job that we've done as portfolio managers, what we're looking at in the portfolio and what we're looking at from a macro point of view. We're going to cover off on 4 topics. We're going to cover off on our investment approach and performance over a longer period, performance summary over the last 12 months and lessons we've learned, macro risks and opportunities for the portfolio, a few of our current themes and ideas, and then finally take some questions. So with that, I'm just going to share the presentation. And just before we begin, some usual disclaimers that this document's been prepared for general information purposes only, and persons should rely solely on their own investigations in respect to the subject matter discussed in this document. Past performance information given in this is for illustrative purposes only, and should not be relied upon as an indication of future performance. So I can assure you that we'll be doing our best to ensure we maintain our historical performance. Just a little bit of housekeeping. We only run one strategy, but we run that across 2 funds. We have a fund for Aussie investors, and we have a Cayman vehicle for offshore investors. Just for simplicity and consistency, all performance references in this presentation will be for the Cayman fund. So let me begin with a little bit of a brief history of the investment approach, and then finish with some longer term performance metrics. What is asymmetric investing, which is what we call ourselves? Our aim is to deliver annual positive absolute returns over the long term, and importantly do that irrespective of any financial market performance. And in simple terms, asymmetric investing to us is all about producing above average returns with below average drawdowns. And we do this by finding good investments, not losing money in the pursuit of realising those good investments. Our asymmetric approach has 4 pillars. Find asymmetric themes, invest in the best ideas within those themes, focus on macro drivers for risks and opportunities to generate an asymmetric return profile. Where did it come from? Bit of history. I grew up on a cotton farm, went across to Memphis to work for the largest cotton traders in the world at the time. Worked for a guy called Billy Donovan. He was Paul Tudor Jones' uncle. And those guys and that whole ethos was my introduction to asymmetric investing. I then went and worked for Macquarie, and Macquarie honed my risk management skills, founded Arnott Capital and the strategy in '99, and we've delivered asymmetric returns ever since. I want to spend a little bit of time, first of all, just really sharing with you how we go about starting with the ideas, where they all come from, and how they end up in the portfolio, because this is probably at the crux of how we think about managing the risks within the portfolio, and that is really curating and putting together a bunch of eclectic, interesting themes that are not all going to go wrong together, which is really critical to our way of thinking. We have a disciplined 4-stage process that we go about. We identify themes, we identify the best ways to express that theme, we determine market factors for entry and exit, and that determines the portfolio construction. So I want to start right here, which possibly could be the most important thing I think that I could share with you on the whole concept of being an asymmetric investor. There's 4 buckets where we typically find these opportunities, and obviously opportunities can come outside of these, but let me just sort of talk about these 4 buckets. The first one is asset backing. And the point I would make as I talk about these 4 buckets is you'll notice as I go through it that we focus first and foremost on downside risk. So the first thing we do is we try and identify how much money we can possibly lose in the opportunity. We do that first and foremost before we look at how much money we think we're going to make. So naturally, asset backing opportunities allow us to value it, and if the markets are valuing them close to that or even below that, then that to us gives us a really interesting opportunity. Temporarily out of favour is less quantitative than asset backing. It certainly requires some interpretation by us as investors, but it presents a lot of interesting opportunities. Supply and demand imbalance, we have a large position in the portfolio in uranium. We've had that position on for a couple of years now, and that sits fairly and squarely in a supply and demand imbalance. It's been a really interesting hunting ground for us, really forever. It lends itself well to commodity supply and demand imbalances, but it doesn't have to be just that. And in fact, you know, one of the newer areas, which we're going to talk about briefly towards the end of the presentation, is that the globe is politically and from a consumer point of view becoming heavily focused on decarbonising the planet, and that is going to produce an interesting supply and demand imbalance for companies who are emitters, you know, looking to reduce their emissions. And then the last one, early stage secular trends, again, qualitative, but I think the important thing is you're not going to find us investing in late stage trends where valuations are higher. We just find it really tough to figure out what our downside is in those sort of themes. And probably there's easier ways to get exposure to it. We're really focused on doing something that is interesting and that is non-mainstream. On the 4-stage process, we start with an unconstrained global universe, and I think this is at the crux of what gives us the flexibility to put together all these really interesting opportunities, because we really do have a totally unconstrained universe. Although we are primarily global investors and largely really looking for good companies around the world, we will look at any asset class where we find opportunities. So, you know, we will invest in commodities when there are opportunities there. We will invest in carbon products. We'll invest in crypto products. We'll invest in fixed income or hybrids of equities, convertibles when there are opportunities there. We will spend a lot of time investing in equities and other asset classes as opportunities arise. From what starts as a global unconstrained universe, we distill that down to about 30 themes that we do work on, detailed work on, trying to find the interesting opportunities and companies within that or instruments within that to express that idea. Out of that, we end up with about 5 to 10 themes which are eligible for the portfolio. And from those, we end up with 3 to 5 which actually make it into the portfolio. So you can see from where we start, there's a heavily cut and screening process to what ultimately ends up into the portfolio. When we think about buying businesses specifically to invest within these particular themes, we're really looking for four things. We want to buy good businesses that are growing their earnings with a capital structure that we can understand. And what I mean by that is we will from time to time take on companies that may have debt. We're not averse to that if we can understand what that capital structure is, particularly tied in with perhaps some margins of safety around asset backing. And lastly, you know, we want to be in business with good people that know how to run those businesses. Just want to spend a bit of time talking about one of the things which differentiates us from a lot of our friends and fellow investors. Look, the investments that we're looking to make, we want to hold for a long time. We do a lot of work on them, and the last thing we want to do is have those situations, where we get out of them quickly. So we're typically looking at an investment horizon of longer than 5 years. But what we do is, having been in markets for a very long time, and I'm sure a lot of you are all aware that, sometimes market can get a bit crazy, and companies which we hope to invest in that are going to grow their earnings in a fairly constant fashion, sometimes the market will get overexcited with these names and value them in the short term a lot higher than what they're worth, and sometimes they value them a lot less. And so what we aim to do is to take advantage of some of those gyrations, not to actually significantly change the portfolio. The underlying portfolio remains very, very similar, but what we will do is we will nudge up and nudge down our position holdings as we go through that cycle. When we're making decisions on that, the tools we're using are almost completely dislocated and separate from the tools that we would use for our investment decision. We're looking at supply and demand, who's buying and selling. We're looking at company events, are they on roadshows, are they reporting, what's going on with underlying linkages, because it's going to affect the performance, and always a bit of a peer cross check for a bit of sanity. And so what we end up with, and this is the crux of where we end up with, is a portfolio where our net exposure, our overall market exposure, is determined by our macro view, and we will manage that and alter that when we need to tactically with index futures. Our gross exposure, which are all our good companies we own and our investments that we don't like, or our index hedges, is a combination of top-down and bottom-up views. All themes, including shorts, are generally designed to create alpha. That is, we don't tend to run a sort of long stock versus short stock and overall run a hedge. We like themes, we like to find themes that we want to be long, and then we just want to be long that theme and every name within it. This fourth point is probably the most critical point. If I could just dwell on this for a minute. We spent a lot of time setting the portfolio up for a broad range of market outcomes. We think, as an absolute return investor, it is our responsibility to prepare this portfolio as an all-weather portfolio to try and manage external events as best we can. And we can never, ever make assurances that we will always be able to do that, but it is a constant obsession of what we do. And I think it's just worth spending a little bit of time on this, that it is easier to be a pure opportunist and just go and find really good investments, bottom-up guy, not going to worry about macro. And, if my portfolio falls 50% because of some external event, well, that's fine, because my bottom-up investments are going to come back. That is an easier job to do, to isolate yourself from the macro risk. The other side of the coin then is to be a risk manager and to be constantly obsessed with macro events, most of which will never happen. And that's also an easier job to do, because you just don't take a lot of risk. And the job and the responsibility, which we take very, very seriously, is trying to manage those two personalities, the opportunist and the risk manager. And it's a really, really tough job to do well, and we take it really seriously. And that is absolutely what we think is at the core of being an asymmetric investor. As I mentioned earlier, we end up with three to five key themes in the portfolio. When we find a theme, we do a lot of work on it. We want to put a lot of money to work. So typically we've got 10 to 25% of total exposure in these key themes. When we do the work on the themes, it is not always, and typically around a group of companies, the last thing we want to do is put all our eggs in one basket and end up with some idiosyncratic company-specific risk, which may see that company fall. We ride on the theme and we don't make any money out of it, or suffer big losses. So we like to put a few names in there just to try and mitigate that idiosyncratic company risk. And what that distills down to is a portfolio which typically has 40 to 70 names. We mentioned at our last update that shorting's been a bit challenging. Shorting in this environment remains challenging. You've got rates close to zero. That poses three broad problems. First of all, at rates close to zero, you get no rebate on your short stock. So you start way behind relative to where we were 5-10 years ago. The second thing is with rates close to zero, banks are far less inclined to call in loans. And so companies which perhaps aren't as fiscally responsible as they should be are surviving as zombie companies, a lot more of those going on. And then, the third thing more broadly is that with lower rates, we have a risk-free rate which increases valuations. And I think those three things probably here for the moment to persist, and we don't see the shorting becoming a significant part of the book in the near-term future. The reason I mention that is that for us to end up with 70 names, we're probably going to have a lot of shorts. We don't at the moment, which is why the portfolio is typically sitting around about 50 at the moment. And then mirroring what we do in themes, our individual positions that we like, we want to put a lot of money to work, so they typically run 5 to 10% of the fund. This just gives you a bit of a snapshot going back in history about what sort of risks we run. The blue line indicates our gross exposure, typically runs more recently around 150, and our net typically runs about 50. So what that means is that of all the assets that we're running, we've got a bunch of ideas that we really like, which are typically around about 100% long. We've got some shorts against that, which are names we don't like, themes we don't like, and some index hedges running around 50, putting us at about 50% net. I do highlight that we are not a market neutral fund. We are not a long only fund. We have flexibility in the same way we have the flexibility to hunt globally for interesting different ideas. We have flexibility to change our exposures depending how we feel about the market, largely driven by macro factors. And it's pretty obvious where we're going to sit. If we're in a grinding bull market, we're going to be as long as we're brave to be without risking drawdowns, trying to keep up with the market going up. If we're in a different market, and I'm going to talk about this a bit later, but this period here, you can see that our nets, and these are average monthlies, so they're moving around pretty aggressively during that 14-15 period. That was a period, coincidentally, when central banks had their training wheels on for tapering. It was the first time they'd really done any serious tapering, probably, I guess, since going back to the Second World War. And not surprisingly, that sort of came with a few bumps in the road and provided some real opportunities for us to move around our nets and produce some pretty good returns out of that. And just to hold that thought, because we're going to talk about that because we may be entering a period like that again. This is just a visual, I think, where we like to go to the videotape, because it's all well and good to sit here and talk about our process of being asymmetric investors. We've done it for a long period of time, so it's worth going to the videotape just to see how we perform. We use a lot of leverage early on. We're not going to replicate that. These are quarterly returns, and this is actually, for those of you who know me, this is a real bear bug of mine. We are all taught in theory books that what we want to do is invest in opportunities, invest in funds and opportunities where we're, say, delivering low double-digit returns with single-digit volatility. And to be honest with you, I just think it's a complete load of rubbish, because the last thing that we want to do is contain our upside returns. Why would anyone want to do that? And we certainly don't attempt to do that. So, these are quarterly returns. And what we do in our portfolio is when things are going well and all our themes are working together, they don't always, but when they are, we let them run and we let them make money, and they're going to be producing volatile returns on the upside, everything we all want. What we will spend a lot of time focusing on is when we've made mistakes and we're not seeing it well and our themes aren't all working, or we've got some macro concerns with the overall market that are making the overall market go down. Well, then we're going to batten down the hatches and we're going to try and do our darndest to not have volatility on the downside, which is really about losing money. That's all we care about. And over a very, very long course of time, that's exactly what we've done. And that is absolutely the crux of being an asymmetric investor. Let the volatility run on the upside to make outsized returns when things are going well, and when things are not going well, don't lose money, or at least attempt not to. Just to look at that by the metrics, of course, there is no average. I do encourage you that there's probably no one period where we produced over 24%, but this is where it's averaged out, 24% versus the global MSCI at 9. And important for us, when the MSCI has had down months, it typically, or on average, has a negative 3.21%, and we've been able to deliver in the past positive returns. Now, when you put these portfolios together with all these idiosyncratic ideas, we spend an enormous amount of time thinking about how those ideas, we look at historical correlations, but we also just really try and think about the linkages associated with those themes and how they're going to interact under various scenarios going forward. And so it is not by accident, but it's by design that we end up with a lot of different risks and opportunities in the portfolio. One of the side benefits of that for people that are interested is that we actually end up uncorrelated with global equity markets, and Australian equity markets are very correlated with global, so you could say uncorrelated with Australian equity markets as well. We end up uncorrelated with bonds, government bonds, uncorrelated with gold, uncorrelated with commodities, and in actual fact, even uncorrelated with our friends who operate in the alternate space, specifically in our space in the equity long short. Just really briefly, we're not going to talk about all these themes in detail, but I guess seeing we've spoken about how we curate the portfolio, what's in there at the moment, where we've got a large position in uranium still. Look, I've just got to mention here that we're actually really boring investors, but Yianni, who runs the portfolio with me, is also head of creativity as our creative director, and comes up with all these fancy names for our themes. Connecting the future is actually all about data storage transmission, 5G, really, really interesting space. We've been in it for a while, and Yianni's going to cover off on that and just talk about it a little bit. Content anywhere, anytime. We've got a lot as consumers. We've got a lot of content coming towards us. One of our favourite subsets of this is that we all listen to music every day through various applications. Ultimately, that is a whole huge fragmented industry of artists that come to us, interestingly, via primarily 3 record labels. So that's a really interesting space that we like. Real assets is fairly obvious what it is. Commodity bull market's a newer theme, and we're going to talk about that a little bit. Just experience first things. Look, I'm just going to take 5 seconds to talk about our views on COVID and Delta strain. A little bit like our macro views, it's a moving feast. We monitor every day, and can be prone to change our minds. So don't take this as gospel. But the way we see it at the moment is it's really, really, really worthwhile what's happening in the UK. The UK to us is a really interesting test case as to what happens when you have a reasonable portion of your population vaccinated and you let it out. And our observations are that while the cases are very high, the hospitalisations and ECU numbers in ECU are actually pretty reasonable. Seems to be going okay for those of you here in Australia, and I guess specifically in Sydney, where a lot of people in lockdown at all. It feels awful at the moment, but if we could step back from the coalface, it looks to us like things will change, certainly at some point in the next few months and definitely in the next year. And this is really important because while we're all locked up, all we're doing is buying things. I can't help myself and duck into super cheap auto every weekend, buy another new thing. And we're not flying anywhere. We don't have any experiences. We're not experiencing anything. And we think that there's going to be, and indeed have some of these positions on now, where the experienced companies some of them seem to be priced as though we're never going to experience anything. And some of the thing companies seem to be experienced as though we're never going to stop buying things. And hence they're on the long and the short. The short list is pretty short, pardon the pun. We've already mentioned why that is. I will mention this one. We're always trying to find interesting things. And, if I sort of go back in history to 2000, we did really well between that bear market. Market broadly fell 50% and lasted about 3 years. And there were terrific opportunities to find companies at extreme valuations with very optimistic earnings forecasts. And we were able to make money on the short side two ways. We had multiple compression and we had earnings downgrades coming down. I don't think we're in that environment now, and I think it's going to be far more challenging. But interestingly enough, there are a lot of companies trading at nosebleed valuations with very optimistic earnings. And so what we have on is some of those names from time to time, we're using them as a put, because although the historic volatility in beta will probably show them maybe 1.5, maybe a little bit higher, it's our experience that some of those names will actually give you beta 3 on the downside when markets become untidy. So they're just a really useful tool for us to put into the portfolio when we get a little bit worried about the market top down. I'm going to leave our long-term summary and now hand over to Yianni, who's going to cover off on performance over the last 12 months, or in this case, we're actually covering the July to June period and lessons we've learned. Over to you, Yianni.
Yeah, thanks, Kenny. And I'll take those kind words you said before as a cue to add head of creative content at Arnott Capital to my LinkedIn profile after this. So today I'll be going over our performance summary for the last 12 months, talking through our key thematic contributors and recapping the underlying drivers of our theses within these themes, as well as providing a little bit of colour on where the portfolio is currently positioned. So pleasingly, over the past 12 months, the Arnott Opportunities strategy delivered a net positive return of positive 44.81%. So you can see in front of you the top 5 contributors to fund performance and the one major detractor. I'm going to go through in a little bit more detail our uranium theme, our connecting the future theme, and index hedges, but I may take the chance to just quickly touch on the other themes that are in that table. So our content anywhere, anytime theme, as Kenny's already touched on, is centered around record labels controlling the distribution of music. That's still an active theme, and we're incredibly excited about the opportunities there. Hong Kong, China is actually not an active theme in the portfolio at the moment. Given the changing regulatory landscape that's going on in China, we decided to take a step to the sideline and are currently watching the developments unfold. Real assets, look, we've materially upweighted that theme within the portfolio. It's now the 3rd largest theme at around 18%. And the reason behind that, as you know, I'm sure most of the people on this call are consciously aware of, the Delta variant that's ripping through the east coast of Australia has seen a lot of the country in lockdown, which has put a lot of quality assets on sale, and we've been taking opportunity of the attractive prices to pick up really high quality assets that we think, you know, this time next year will be materially higher. So I'm going to quickly run through our uranium theme, which, you know, pleasingly was the largest contributor to fund performance over the period, adding just under 14%. And look, despite this stellar performance, it still is our highest conviction theme within the portfolio at a weighting of about 20%. And the reason for our conviction within this theme is that we believe we're now through the trough of a 13-year bear market, as uranium prices have fallen from a high of $140 to touch a low of around $20. We think we're now through the trough and we've seen the bottom, and we're now at the dawn of a new structural bull market for uranium. What we've seen transpire in recent time is that the headwinds that have plagued the sector for the past decade are now turning into tailwinds, as Western reactor fleets that were initially slated for shutdown are getting significant life extensions. And this is also coming at a time where Indian and Chinese nuclear fleet build-outs are about to start coming online, really strengthening the demand profile for uranium going forward. This is also coupled with, I guess, a really large sentiment shift that's transpiring for nuclear energy. I think what's going on is governments around the world are realizing that nuclear energy is the only reliable source of clean, green baseload power. As governments pledge net zero carbon emissions by 2050, I think everyone's waking up to the fact that nuclear energy has a pivotal role to play in achieving this goal. And without nuclear energy, we just can't actually see how this is going to occur. So all of these positive developments are transpiring on the demand side. On the supply side, it's getting more and more precarious. What initially attracted us to the uranium thesis a couple of years ago was the fact that we could see a looming demand-supply imbalance starting in around 2024 as the nuclear reactor fleet build-outs in China and India came online. What's happened over the past 12 months is this demand-supply imbalance has been brought forward to the present day. You've seen the largest suppliers of uranium, being Gazprom and Cameco, shut down mines and withdraw copious amounts of supply from the market, as they believe that the current spot price of $31 per pound of uranium is unsustainable. They believe that uranium prices should be around $50 and potentially north of that, which is the long-run industry marginal cost of supply. So why we're so excited about uranium, and it is the highest conviction theme within the portfolio, is that we believe a key catalyst to drive a big increase in the spot price of uranium is about to come to fruition. We think that US utilities are about to come to the term contract market, and they're going to start engaging with these suppliers to set long-term supply arrangements. And what we've heard from the suppliers is they're not going to supply uranium at $30 a pound. We think they're going to engage in contracts well north at around $50 or potentially north of that. And the reason why this is about to happen within the next 12 months is that you can see at the chart to your bottom right is that US utilities are at a point now where they actually have uncontracted supply to meet the demand of these nuclear reactors. This is very dangerous for a nuclear energy plant. If the key thing to run the plant is uranium. So if you don't have a line of sight on where your uranium's coming from, you can't run the plant. So look, we're tremendously excited, and we think, as you can see the uncontracted demand increases as years go out, we think that it's only more and more likely you're going to see utility companies contract, which is going to drive a material uplift in the spot price. And as we've been saying for years, the only cure to bridge the supply gap is higher prices. So I'll leave it there on uranium, and I'll move on to our connecting the future theme, which pleasingly contributed just under 7% to fund performance over the period. So I guess our connecting the future theme is primarily centered around the fact that as economies accelerate the digital transition, more and more data is going to be demanded by corporations, governments, and consumers. When you think about it, streaming hours of Netflix, conducting webinars over Zoom, and looking slightly out into the future at autonomous vehicles and I guess smart cities, the demand for data is only increasing at an accelerating rate. So as the demand for data increases, so too does the demand for the digital infrastructure that transmits all of this data, being telecommunication towers, data centers, and the connective fiber. More data demand leads to more earnings for these quality infrastructure assets. And what really is attracting us to this theme is that these long duration growth assets are embedded within, I guess, boring telecommunication companies that are trading at depressed multiples because the market's just completely uninterested in them. And this is happening at a time where there's record amounts of undrawn cash sitting within private equity funds and superannuation funds. And the intersection between those two themes, which is long life, high growth duration assets, copious amounts of cash sitting in private equity and superannuation funds, is really what drove a significant amount of the performance of this theme over the period. We had two portfolio positions, which were Vocus Communications and Infratil, received bids over the period. And what really excites us is we think this trend is only just beginning. And we're finding more and more boring telecommunication companies with high quality infrastructure assets every single day. And that's why the connecting the future theme's sitting at about 19% of portfolio exposure is our second largest theme. And we're really excited about prospective returns. So I guess I can't leave it there on connecting the future without touching on Telstra, which, we sat here 6 months ago, we told everyone it was our highest conviction name. We were essentially banging the table on it. And look, despite the fact that Telstra is up 30% in the calendar year to date, it still is one of the largest positions within the portfolio. And I guess this reflects the conviction we have in this name. So I'm going to talk through the three drivers of why we're still highly convicted in Telstra and think it's going to generate significant returns for the portfolio in the coming years. First of these is we've seen the recent monetization of their towers portfolio. The price that Telstra received for these towers was well and truly above what we believed, what we were modelling in our numbers and what we think a lot of our peers were also modelling. So we said 6 months ago, we believed asset backing of Telstra was between $3 to $3.50 a share. Well, we now have extreme confidence that we're sitting at least $3.50 a share of asset backing for Telstra, which underpins the current share price. Secondly, we've now seen the bottom in mobile pricing trends. We said 6 months ago when we spoke to you all that we thought we were seeing the bottom, and we've now gone through that point with both Vodafone and Optus lifting mobile prices. We think this is going to be a significant earnings driver for Telstra going forward in the coming years, and we think, you know, the share price will reflect this earnings growth. And lastly, we think the market really underappreciates the current 5G, the current dominant position Telstra has in the 5G wireless rollout. We think that they will be in a prime position to benefit from the explosion in the Internet of Things and deliver really unique, bespoke enterprise solutions to customers as a lot of these companies take advantage of the digital age. So, look, I haven't had a chance to go through Telstra, which reported today. It's always a bit nervous when you talk about a company and they've reported. So please don't hold me to what the share price does today. This is a long-term investment idea, and you know, we'll see how it goes today. So I'll leave it there and move on to the most material detractor to fund performance over the period, and that was index hedges, which detracted just under 6% to fund performance over the period. And as you can see from the chart in front of you, which is the MSCI World, you know, the optimal decision was to run completely unhedged over the period. And that's the thing about hindsight, everything, you know, it looks so clear in the rearview mirror. But to sit here and say we should have been unhedged, I guess wouldn't really give credit to our process and what we do here at Arnott. You know, so I'm going to go over why we use index hedges, and it centers on two primary reasons. So firstly, we utilize index hedges to, I guess, protect the portfolio from just general gyrations of equity markets. You know, markets can go up 5%, down 5% very quickly, and we want to protect the portfolio and allow our long-term thematic ideas to generate absolute returns over the cycle. And then secondly, in addition to protecting investors' capital from the general gyrations of the market, we run index hedges because it forces the long ingrained discipline at Arnott of watching out for macroeconomic risks, opportunities, and genuine tail risks to protect investors' capital. You know, if you see the chart on the next page, it wasn't very long ago that equity markets fell 20% in just under 2 months. So by constantly looking out for tail risks and forcing that discipline, we believe we're in a very good position to protect investors' capital going forward. So in summary, whilst index hedges were a drag on fund performance over the period, it's part of what we do. And so in grinding equity bull markets like we've seen of the past year, it will be a drag on performance. And unfortunately, this isn't going to change. So I'll leave it there, and I'm going to hand it back to Kenny to go through our current macro thoughts.
Thanks, Yianni. So I just wanted to take a bit of time looking at macro risks and opportunities that we see for the portfolio. We always go straight to our macro flow checklist whenever we're trying to get a sense or to make some sense of what's going on in the world. And this has served us, it's pretty simple, and it's served us pretty well over a long period of time. A lot of our focus is what goes on in the US. The reason for that is that our macro focus is predominantly around, you know, doing our best to make sure that the market that the portfolio doesn't blow up under difficult scenarios. And so ultimately, it's really important to pay attention to what goes on in the US. So our starting point is that central banks determine where monetary policy is, which largely goes a long way to determine the flow-on effect of everything in the global economy. We have added to that, or we're certainly focusing more recently on fiscal flows, and I think we're going to see a lot more of that over the next decade, that the power of the central banks is potentially going to shift fiscal power. So where are they? Well, the Fed and central banks continue with enormously stimulatory and very loose monetary policy, and that is happening in combination with a whole large amount of stimulus from governments around the world. How is that affecting the economy? Well, if I could just sort of step the delta component aside, the economy's going remarkably well, given where we were only, in sort of March 2020, in the middle of the COVID pandemic, the first stage of it. Thirdly, how are the equity markets thinking about that? Well, not surprisingly, they've figured out the economy's going pretty well and things are valued pretty highly. And we've just come through a Eunice reporting season that's quite remarkable and, really good. In fact, if 2020 was all about valuations going up, then 2021 so far is almost about earnings moves within the market. Where's everyone positioned on the back of that? Well, it's hard to say, but I'd say people are unhappily long in the market. We always then say, what else do we need to think about right now? That's obviously delta. It's really important when we look at this, not to look at absolute levels, we look at the rate of change. The rate of change is what really drives markets, in our opinion, and then we map out a timeline of events for how we think we should position the portfolio. I want to just be brave enough to look back over the last decade and look forward over the next decade and just sort of share with you our observations, because we think it's going to be very different. If we look at the last decade, what we have all experienced is massive rise in asset prices, accompanied by rates coming down and a lot of large injection of liquidity and asset purchases by the central banks. And you don't need to be a rocket scientist to look at this and to form some view that asset purchases by central banks seem to be somewhat correlated with markets going up. And so it probably makes sense to us that you want to have a bit of a view as to what's going to happen with those asset purchases going forward. Now, if you owned a house 10 years ago, or you owned a lot of assets 10 years ago, you've done really well out of that. And if you didn't, you haven't. And so there's now a massive wealth gap. And it's a wealth gap which is gaining a lot more attention. It's gaining attention both in the political landscape, and I would say, interestingly, it's also gaining attention from central banks. I think it was the June minutes, if you read some of Powell's comments, he seems to have taken a more liberal approach as to what their role is with regard to maintaining full employment. In fact, it almost seems like they've now taken a role as to targeting, underprivileged groups, and it's almost a more social role now, without making any sort of moral call as to what we should be doing, although it certainly seems the right thing to do. The most important observation to us is that there are going to be changes. There are going to be changes that people think about, and it's around that inequality. Now, while of course we've seen these massive asset rises, on the other hand, to a whole series of reasons, there's been deflationary forces at work, keeping prices of goods and services, including wages, in check. And this is part of the reason that if you didn't happen to own those assets, then in the last 10 years, you're a lot further behind your peers. So if we just sort of start with the rates issue, I mean, rates came from the mid-90s where you could get a reasonable risk-free return at around 7%. Now you can't get a risk-free rate of return at all. So rates, have come from, call it 5 to 7 to 0. Well, I'm just going to make a call. They're not going to -7. So we've probably finished that move. And they may stay low forever. That's sort of seemed reasonable, but certainly the rate of change is slowing. So that tailwind's gone. And the other thing is that that's happening at a time where we're probably going to see a lot more pricing pressure on goods and services. And this is absolutely critical, I think, to some really interesting opportunities that are going to take place over the next decade. And, we often say it's folly to try and figure out whether global economy's going and where macro's going. There's so many moving parts, and so we're not sitting here trying to have a broad view on where inflation's going, but we are spending a lot of time thinking about where we can quantify that there are going to be some price rises, and then there may be some businesses that are going to benefit from that. So that is a core part of where we're spending a lot of time working, reading, listening, talking, and Yianni's going to talk about that in a bit more detail when we talk about our current themes. Before we move to that, we better just talk about our short-term view. We're always watching macro. It's an obsession which is most of the time a waste of time because markets are generally okay, but keeps us out of trouble, and we're always going to be doing it. So why don't we just update everyone on what our current thinking is? This probably sums it up. That right now, central bank activity is causing consumers to pay more for goods. Now, this is quite interesting. It's making consumers very unhappy. In fact, recently, I think it was last weekend in the US, which saw a survey, 70% of consumers are extremely concerned about their cost of living going up, and 60% of those are blaming Biden. Now, it's not actually Biden's fault. It's central banks, the policy that has really led to this. And this is a really interesting dilemma, because if you go back to the March 2020, the central banks have done an outstanding job of providing a whole lot of liquidity, and the governments have as well, which has really prevented what would have otherwise been a terrible recession due to COVID. That not taking anything away from the brilliant job they've done, basically all they had to do was throw more at it until it eventually fixed the problem. And they're now in a difficult situation where, because of all this, we've got inflationary effects coming through in cost of goods, which is going to affect the consumer, which is going to put pressure on the politicians, particularly Washington, which means we've kind of got a bit of pushback coming between the central banks and the consumer through their representatives in Washington. And this makes the central bank's job a lot harder right now. At the same time, we're hearing a lot more about tapering. We're going to hear a lot more about tapering. I mentioned earlier in the presentation, the last time they went into this, the market went through some really volatile periods. It just seems logical to me that if the Fed starts tapering, it's not going to be supportive of markets, and all else being equal, is likely to lead to higher volatility. Now, that may not be the case. We might get through this just fine and everything is going to be dandy, but it's got us on amber alert for the 1 to 4 months, and amber could turn to bright red very quickly. So that's our macro tactical view. We remain extremely excited about a whole bunch of long opportunities that we've got in the portfolio. I wouldn't say that we're structural bears. We're just saying there's a very interesting period which we're now approaching, which probably has the ingredients to unsettle the market a little bit. And so we're just going to keep an eye on that until we get through that period. We've got Jackson Hole coming up, and then we've got August, September, October. The markets always get seasonally a bit untidy. So yeah, I think it just warrants being on amber alert for the next couple of months. I'm going to hand back over to Yianni, our creative director, to talk about a few of our newer themes and ideas now.
Thanks, Kenny. So I'm going to talk about a relatively new theme that's emerged in the portfolio, and that theme's our commodity bull market theme, which, as the name suggests, very uncreatively, it centers on the fact that we're extremely positive on commodity prices going forward and believe that these are going to drive high returns for commodity miners and producers. So Kenny briefly touched on this, but we really believe that we're entering a new paradigm of government fiscal policy, as governments run sustained fiscal deficits with spending on targeted infrastructure projects and decarbonisation initiatives that aim to attempt to lift the social welfare of their citizens. This spending, in our opinion, will drive sustained, stronger for longer commodity prices. So I guess instead of delving deeper into our views of the changing government fiscal policy landscape or talking about commodity complex as a whole, I thought it'd be time better spent to focus on where we're seeing the highest risk reward opportunities within the commodities complex. And I'm going to talk briefly about steel equities and the opportunities that we see in that space. So firstly, I'm going to talk about global steel markets, and then I'm going to talk about how we're investing in the asymmetric opportunity we see in steel equities. So within global steel markets, we believe we're at the intersection of two very powerful trends that are going to drive stronger for longer steel prices. The first of which I've already briefly touched on, and that centers on fiscal spending. The second is the changing policy landscape that's emerging out of China as they push for net zero carbon emissions by 2060. So this is the part of the narrative that I really want to focus on, as we at Arnott believe that this is really underappreciated by the market, and this monumental policy shift will have far-reaching implications for global steel markets. So to understand where we are now, I'm going to go back in time. So from 2005 to 2020, 96% of global incremental steel supply has come from China. This supply has been incredibly cheap, and we understand why Western producers have been buying Chinese steel. But the fact that it's been so cheap has come at actually quite a high environmental cost. So for every ton of steel that's produced in China, there's roughly 2 tons of carbon dioxide emitted into the atmosphere. To put it into perspective, in a Western steel producing region such as Europe, that sits at under 1 ton. So for every ton of steel produced in China, I guess you could say the outcome is twice as bad for the environment. So fast forward to 2020, and the domestic steel production sector within China accounts for 15% of the country's total carbon emissions. So as China ushers in a new age, enacting environmental policies, they are first targeting the domestic steel producers. And to highlight how quick that the policy shifts occurring within China, we just want to talk quickly about what's going on within the domestic steel market in China. So at the start of this year, the start of 2021, domestic steel producers received subsidies for exports of steel they put into the global seaborne market. In March of this year, that subsidy was removed. And presently, Chinese domestic steel producers are actually taxed for any exports. This is also coming at a time where the Chinese government is thinking of including Chinese steel producers within their carbon emission trading system. This is going to add a significant incremental cost to Chinese steel producers. So with a tidal wave of demand coming, we believe that this is incredibly important. We've seen the past 15 years, developed economies become hooked on cheap Chinese steel, which is now likely to actually be withdrawn from seaborne markets. We're probably going to see China become a net importer of steel from a net exporter. This is huge, and we think is really underappreciated in markets at the moment, and will be one of the structural drivers as to why we're going to see stronger for longer steel prices. So I'm going to take it back and talk about why we think there's an asymmetric opportunity given this within steel equities. I'm sure everyone on this call has heard the word transitory more times than they can count. And there's good reason for this. There are genuinely transitory forces going on in global supply chains. You know, we've seen lumber prices within America go up 500% and then reverse course the whole way and are now actually lower than where they started. But we think that this is within specific areas. But what's happening is equity market participants are taking this view of transitory and applying it to all commodity equities. And this is none better illustrated than within steel. So currently, US steel producers, their share prices are reflecting a steel price which is 50% below the current spot steel price. We think as equity market participants wake up to the fact that steel is going to be stronger for longer, this presents a tremendous opportunity for a re-rating of these steel equities and are investing in the space. You know, some of the names are on 30 to 40% free cash flow yields, quickly transitioning their balance sheets to net cash, and it's incredibly attractive. And you know, we're really excited about the prospective returns from this theme. So I'll leave it there on our commodity bull market theme, and quickly touch on a theme that's really in its infancy in the portfolio. We've deployed very limited amounts of capital in the space, but we thought it would be really instructive to just touch on our thoughts here and kind of give a little bit more information on it, just so that you know what we're thinking and how we're thinking about inflationary forces in the global economy. So the theme I'm going to talk about is decarbonisation. And what this theme really centres on is the world's transition to net zero carbon emissions by 2050, and what does a ton of carbon emissions actually cost? You know, it seems like almost overnight there's been a huge groundswell in activity. There's been reports published, everyone's talking about it. How's climate change going to be implemented? How's the world going to get to net zero carbon emissions by 2050? And we're just asking ourselves in practical terms, as being realists, is how much is this all going to cost? There's been so many pledges, so many governments being involved in the space, but at the end of the day, what we're trying to do is completely change the energy supply chain. We're completely trying to change how we produce things, how we farm, how we heat and cool ourselves. And this is a monumental shift that is going to cost a lot of money. So I guess to just distill our thinking incredibly simply and kind of where we've got to in the space after thinking about it for quite a long period of time is that we think it's going to cost quite a lot. To illustrate this simply, there's around 51 billion tonnes of CO2 emitted into the atmosphere per annum. The largest and most liquid carbon credit market is the European Union Emission Trading Scheme, which prices a tonne of CO2 at $66. So 51 billion times 66 equals around $3.3 trillion. Or put another way, that's about 3.7% of global GDP. The unfortunate thing is that we believe that we, the consumer, are going to have to end up paying for this, as governments can't achieve net zero carbon emissions without putting a price on carbon. You need to price carbon to actually stimulate technological innovation. So I'm going to leave it there, and I won't delve into where we're seeing opportunities because we really haven't deployed much capital, and it'd be a bit early to talk about it. So I'm going to hand it to Andrew and go through some questions.
Yeah, thanks very much, Yianni. Good morning, everyone, and thanks very much for your time. We do have a few good questions that have come through over the past few days, and just in the interest of time, we'll get through these relatively briskly. So if you require any follow-on, look, please don't hesitate to drop me an email or give me a call. First question is, what is the offshore versus domestic exposure of the fund, and how has this varied over time?
Yes, I'll take that one, Andrew. Look, roughly it sits at about 50% Australian equities, 50% global. Look, this does fluctuate, I guess, up and down within a small tolerance, but roughly it sits at about 50-50.
Okay, thanks very much. Second question is the strategy currency hedged or unhedged?
Yes, I'll jump in and take that one again. The strategy is unhedged, but we do regularly review our FX exposures and make active decisions about where we see currency.
Okay, thanks very much. Our third question is, with the US market arguably getting toppy, what are the team thinking about a market correction, and how is that impacting your net and gross exposures?
Well, maybe I'll take that one. Great thing about watching macro is it's a bit like you predict about 15 of 3 recessions that happen, unfortunately, as a risk manager. What I would say, you know, our market's toppy. I think the first thing I'd say is that we don't sort of think about markets without a context of what's going on. So to my comments earlier, it's not, valuation is one of the worst indicators as a market timer. And we do focus on market timing. We have done for years. I think what's much more important is, you know, what is going on in the underlying environment. And the chart that I brought up, which shows that the rate of asset purchases is probably going to slow. If the rate of asset purchases is slowed in an untidy fashion, then the markets will probably be unhappy with that. That is, we are at the pointy end of some of that decision making, the preliminary decision making, having come out of a period of stimulus. So we're acutely aware of it. We're on Amber Alert, as I mentioned. We have bought our nets back. That is on a tactical view just to cover off on what we see as potential risks in the 1 to 4 month period.
Okay, great, thanks. So the fourth and final question is, could you just give some colour on your long short exposures in terms of both size and number?
Again, just probably refreshing us on the exposure chart, I would start by saying that we have a lot of flexibility to vary our exposures based really on how we see risks and opportunities. And, you know, purely as an opportunist, we'd love to have a lot more risk on, a lot more net risk on, a lot more gross risk on. But because we're fairly allergic to having drawdowns in the pursuit of realising our reasonable returns, we're always faced with this, you know, this constant risk manager versus opportunist situation as the portfolio manager. We have broadly run in mid 50% net long and broadly 150 gross, and broadly that's 50 underlying positions with probably 3 to 5 important themes. I mentioned tactically we've sort of pared that back to that band a little bit, and that's probably about all I've got to say actually on that one.
All right, terrific. Thanks very much. And look, if anyone has any further questions or requires further colour, please don't hesitate to get in touch with me at any time. I'll hand it back to you, Kenny.
So thanks very much for your time, guys. I think if I could sum up where we're at, we've probably got a collection of newer things we're looking at, which is more exciting than we've been for a while. There's a lot of bottom-up ideas which are really good, but as we're probably all aware, the overall market is at, you know, a valuation level which is a bit more challenging. And so I would say that our top-down view is somewhat challenging our bottom-up view from a risk management point of view, but remain really excited about bottom-up opportunities, and we'll just continue to do our best to prevent drawdowns as we try and make some money from those. So look forward to working with you guys over another 12 months. Thanks very much. And
thanks everyone.
Thank you.